It's fun to go back and take a look at it over time. Here, as of this morning, this is the Treasury yield curve. The 1 month Treasury bills are sitting up here at what, 5.5%. You get out to a 10-year, which if I can get this garbage out of the way, our 10 years are down here about 3.86%. 20 years, that's interesting that the 20-year part's been starting to tail its way up a little bit. So that's at 4.17. If much about Treasury yield curves, typically the farther you go out, the higher the rate is. So what I would tell people is this is what the market is telling you is the rate that we'll get to eventually. The bond market is saying we're gonna settle in around 4.17. So what does that mean for people that have moved out of money markets and bought Treasury bills or whatever? All of these, you start to go out to 1 year, it is very likely when we start to see interest rates cut, these are the fastest things that are going to mature. They're going to drop. If we were to go back in history a little bit here, and let's go back a couple years to a normal Treasury yield curve, probably March, February, look, January of
probably anywhere in 21.
Yeah, 21, we should be fine. That's a normal curve. Short end was, this time it was ridiculously low, but then you had the high end around 1.65. The 20-year was at 1.45. So that's normal.
And this is what got Silicon Valley Bank and many of those other banks in trouble because they were all loaded up on 20 and 30 year. And then when rates went the other way and they had redemptions, they lost their rear ends.
Absolutely. Yeah. So we go back to today and it changes dramatically. And you need to understand that if you're currently invested shorter term and you're looking at, and honestly, I think Ron and I have been that way. Why not stay in those those shorter term rates? Why not do that? But just realize that 5% that you're earning today is very unlikely. As we start to see interest rate changes, it's very unlikely that those rates will stay where they're at. And you could see those evaporate pretty quickly. Yep. But I think the market's kind of giving you a little bit of a, not a head fake, but a little bit of an idea that it's likely we'll settle in where those longer term rates are about 4.17 on the 20-year. The 30-year will come up slightly higher than that to maybe like 4.40. And then we'll see the shorter term rates all tail off. So that's that end of the curve. Typically, this is telling us there's a recession down the road. Now, is that going to be a strong recession? Is it going to be a recession where we see it be a soft landing or a real hard landing? Who knows at this point, but it's very likely that at some point something is going to have to happen that's going to cause this to go back to what's more of a normal curve.